Hello, welcome back. So, Apple is obviously a company that is absolutely great, and since it has been going down lately in the recent stock market crash, and especially the Nasdaq crash, you will see that it's down 23% since last year. And it may be giving us an interesting entry point. We want to examine the company's financial details here, see whether it makes sense to buy, whether it's actually cheap enough, because we probably already know that this is a great company. It's making tons of free cash flow, pretty much printing money. But the question that we always need to be asking ourselves is, am I getting this one at a good price, or am I overpaying? And this is what we will be answering in this video, because we really don't want to be overpaying for any stock. So, the P ratio of the company at 23 and the price to free cash flow ratio at 24.5. They are both going down, and this is great to see, especially the P ratio going down quite a lot. Great to see. It points to the fact that the company is getting cheaper. I love to see that. Now, the company is also buying back shares in a tremendous manner. They keep buying back shares every year, massive amounts of shares. I think it was like 85 billion or so that they bought last year. Absolutely tremendous. And as a shareholder, as a current shareholder, or even as a shareholder to be, I am delighted to see that. And the fact that the company is also announcing even more buybacks is even better. Now, the total liabilities to free cash flow is a little bit elevated, 3.1 years of free cash flow to pay back all the total liabilities that the company has is okay. I mean, it's pretty solvent. Now, the revenue growth of the company has been increasing with the net income growth and the free cash flow growth. Again, this company is already making a revenue of 360 billion here, so you can't be expecting it to grow at fantastically high levels. This is not going to happen. It's already very high. Even though 60%, starting from 220 billion, that's 230 really, that's very impressive here. Now, the total year equity, the 5-year total equity growth has been going down. And I have made a dedicated video in which I actually explained exactly why this is happening with Apple. You can find it in my channel, actually, if you pretty much search for Apple videos. And the reason for this is basically that Apple leveraged debt. So they actually got a lot of debt because of the interest rates. And it was practically speaking free money for Apple. So they used it for leverage in order to utilize it and make higher returns on equity, for example. And this is why you're looking at this number here, 153%. Return on equity is a number that is calculated by the net income that the company generates when divided to the total equity, the total shareholders' equity. And so, as you can understand, the less equity we have and the higher of a net income we have, we get a higher value here, a higher return on equity. And this is why this is extremely high here, 153%. The company has a high debt to equity ratio. Again, as I explained, they are doing this on purpose. They are increasing they're decreasing the total equity by increasing debt, and this is why you're looking at this high value. This is totally fine though. It is actually very well managed. And net income margin that has been near 26%. It may go down a little bit in this current environment. We will actually work on that using our tool, on our projections. The dividend yield of 0.6%, which is actually as you will see here, it is fairly low, and the free cash flow payout ratio is 15%. And if we take a look at the dividends module, you will see that it has been increasing throughout the years over here, and the dividend yield is effectively pretty much 0.65%. Sorry. And let's go back and see now the financial statements of the company, starting with the income statement. Look at this revenue, 229 billion to 366 over here, and net income of 48 to 94, increasing massively. If you take a look at the balance sheet, you will see that the company's total equity has been decreasing. Again, because of what I talked about earlier, the company has been increasing their debt and pretty much increasing the liabilities here significantly, while their total assets are about the same or maybe even less, and this is why this is happening. And this is again a very managed thing. The company knows what they're doing. They're buying back a lot of shares as well. And so yeah, this actually, when you're buying back a lot of shares, you are utilizing your cash, and this decreases your total equity, as you can understand, because you are using that cash. But for this, you are actually getting back less owners of the stock because you are buying back shares and retiring them. And so now there are less owners and less equity, less owners. It balances itself out. But it is a better thing for current shareholders because now they own more of the company. And if we take a look at the cash flow statement, you will see how the net cash provided by operating activities is broken down here. And also cash from investing activities. Notice here that the company has been buying back some investments here, and also selling some investments as well in terms of investing here, and some capital expenditures, which is very normal. But what I wanted to point out is the dividends paid here, 14.47 billion. And take a look at this common stock repurchased. Amazing repurchases of common stock pretty much every year. The company is spending massive amounts of money buying back their common stock. And as it goes down, they may be buying even more, I'm assuming. So this is why this number is extremely negative here, which is amazing. It's great. Because again, they're buying back shares. Now, they may be buying them a little bit expensive, is the thing. But overall, it's a good idea to be buying shares back if you are a company, shares of your own company. You don't want to be overpaying, though. That's the thing. And we will examine whether that's the thing. So the cash that they have, 36 billion, it still keeps increasing, which is very surprising. After all these buybacks, the stock, the cash that they have at the end of this period is actually keeps increasing right now, because take a look at this free cash flow, 51 billion to 93 billion. Insane increase in terms of free cash flow. The company is making tons of money here. And let's now take a look at the price to pay, because this is very, very important here. Now, the revenue growth that we are going to go for has to be relatively low here. We don't want to go overboard. The company has had years of 5%, 6%, but last year they did 33%, which is absolutely insane for a company that big. It's insane growth here. And we are going to go lower. Let's just go 3, 5, and 7 here and see what we're getting out of this one. And the net income margins, you'll see that we have had it 22, 25. You can, of course, go a little bit lower and try different projections. For the projections here, I'm going to go 20, 22, and 24. And free cash flow margins tend to be near 100% in comparison to the net income margins. So I'm going to go 95, 100, and 105. 13% is my annual return that I want to be making, pretty much out of any single stock. Remember that you can actually subscribe on our Patreon and use this platform in an unlimited manner with all sorts of stocks that you like. You can find links in the description box below this video. And also you can actually join our Discord channel, in which we're discussing a lot about stocks, the economy. Very, very nice discussions we're having there every day, so we'd love to have you around. Let's hit calculate. And you will see here that with this kind of estimates, we are actually sitting at a medium of 82, at a high of 102, at a low of 65. Again, we went with very, very low revenue growth here compared to what the company has been doing. And if we go with something that's a little bit more potentially normal, something that you would expect to happen in the next 5 years, then we're gonna get slightly higher projections. And frankly speaking, at about $100, I would probably buy this company. Even though you're looking at the current price, of course, it's 140. I wouldn't buy at this price. But even though this is a medium estimate and the low one is like 77, there are some very, very positive things about the company which would propel me, and actually would make me really think about buying this one at $100. Many, many nice things to see here. The company buying back shares like crazy. They are making tons of money. They have been buying back shares pretty much every year. If it goes down to $100, we are looking at a P ratio that's going to be significantly lower here, about like 40% lower or something. And the company still makes tons of money, and it's also obviously a very, very well-known big tech giant. And their margins, can be affected a little bit by the current market conditions, okay? But there are many, many good things to see here, and they are still growing very nicely, even though they are a behemoth, really, which is surprising to me. So there are many nice things here, and it is a company that you could potentially pay a little bit of a higher multiple for, because of these great things happening with this one. great returns pretty much, and yeah, I love what I'm seeing here. It is expensive right now at the 140 bucks, and it has to go down significantly lower for me to consider buying it. But I think near 100 would be a price point that I could definitely see myself buying this one. It would be very, very interesting, and it may be slightly more than what I would normally pay, but again, there are many positives here, and sometimes when you're looking at some of these big tech companies, it may be worthwhile paying a little bit more, but you don't want to overdo it. Like I wouldn't pay 120, for example, but I would pay $100 for this one. 120 would probably still be relatively expensive, but 100 bucks, I'm sitting close to where I would want it to be. Now, if I can get it at a lower price, even better. But yeah, at 100 bucks, I would probably think about starting to accumulate a bit here. Thanks for watching the video. Remember to like and subscribe, and I'll see you in the next one, guys. Bye bye.